day, folks. Today's discussion is around transitioning from historical, the past, to the future. It's based on assumptions. Now, when we look at this, I want to go back to the very beginning, okay, where we went through this model, Brown's model, and I want to revisit that for just a second because we have analysis and evaluation. You start by what are the economic characteristics and current condition of the industry in which a firm competes. Okay, now this has been massively impacted by COVID-19 and its result. But we started with this. This is where we started at the beginning of the semester, is here. We looked at that. Then you took a look at what strategies the firm is executing to compete in the industry. Now, some were basically survival, and others were how are they going to grow and change when this is different. We took a look at how well the firm's financial statements reflect the impact of what they had planned on doing in their actions. We had to take a look at sometimes the accounting principles and methods, whether that's GAAP or IFRS, to better understand. We, in the past, just in the most recent one, are there adjustments we need to make to the quality of the information? Okay, those are important things here. We then looked at the profits and risks of the company. We used ratios and other analytical tools. Now, that is Project 1 and 2 is what you have done so far. Project 3 takes us into forecasting. So the first thing we're going to do here is forecast the firm's future profitability and risk, incorporating information on the strategic actions of the firm. What is the firm going to do? The economics of the industry and broad economics, because they will have a direct effect. We'll then move on to valuing the firm using various valuation methods, and then make an investment decision by comparing likely price ranges. So 5 and 6 are essentially what you're going to be doing in application project 3. The video is out there as well as the instructions for you to do that. So where do we start? Well, we start with the basic assumption of any company is its value to generate cash in the future. How is it going to generate cash? Whether that is driven by sales or a buyout of the technology, of the intellectual property, what have you, but somehow to generate cash in the future. Sales is the primary driver of generating cash. So we spent a lot of time on sales so that you can go ahead and forecast this. The question becomes then how do you got to determine the impact of the strategies on existing sales. Okay, projecting the future has many variables. Now, some are internal to the firm, the decisions the firm makes, and others are external to the firm. And oftentimes there's limits to growth, meaning there's things that are limiting what the company can do, whether that be market size, capital, plant capacity, demand, etc. Now, the basic theory of this is to learn from the past, but to look to the future. Reflect and review, but always keep moving forward. We look at basic forecasting approaches, and there are two basic ones. One is quantitative, and that's historical data from time series. That's your charts, your growth, correlation information. Then there's qualitative, opinions from experts, decision makers, customers, or in your case, as an analyst. How do you interpret them? So we're really going to try to incorporate both of these because we have trends. We'll also do a statistical forecast on sales so that we can get a sense, are we in the range? Now, COVID-19, depending on your company, may have thrown that in a very different way. Forecasting is an art based on history. It's not an exact science. There's always ranges. There's many variables. Forecasting is all about building assumptions and then applying assumptions to historical results. And at the same time, what is applying the assumptions to the strategies? Oftentimes, forecasts are shown as ranges. They tend to be 3 to 5 years. Oftentimes, you might hear the word companies give guidance. They will say, we think next year we're going to have sales of between X and X plus 10. So we got to look at that too. So you got to look at your company and what is the guidance the company itself is giving. Then what are analysts giving? Now, there's so many different lines, so many assumptions that we have that we could be here forever. We don't necessarily have all the tools and the ability to analyze everything, but we know that everything starts with sales. So if we come back to the Pareto Principle, 20% of actions give us 80% of the results. 20% of our assumptions that we make, 20% of what we're looking at is going to give us pretty much the results we need. Everything starts with this sales forecast because expenses, gross profit, operating profit are all a function of sales, as well as assets and liabilities, cash flow. So often a forecast begins with a revenue forecast using a variety of inputs, as we said, including trend relative to prior years. Oftentimes it's a top-down approach that we start here, and based on the relationship of what the company does, the change in revenue for the company, we relate it back to a broad macroeconomic indicator such as the GDP. We can use regression analysis to establish some of the parameters of these relationships. Then we could look at market share. Okay, so if a company has 20% market share and the industry is expected to grow by 10, we can make some assumptions around that. And then we can, the company sales are then estimated as the projected market share multiplied from that. So we're really going to be using this approach. What you could do, on the other hand, and this is where you get into practice, what companies actually do is they build it from the bottoms up. Okay? They take each of the company's major products or segments and they project changes in volume and changes in price. And that's where we're doing a little hybrid here, and I know we're all tired of hearing the word hybrid, but we're really taking this top-down macro approach. But we're incorporating some very specific things that are detailed rate volume. Okay? Now, then we're going to look at the others. So let's just keep going with sales. We'll come back to COVID has complicated this process because some company sales went up, some company sales stayed the same, and some company sales went way down. So each company is starting off at a different place. To forecast future sales, we need to make assumptions around the existing or base business. This is going to be driven by basically the broad macro environment, including GDP growth and inflation. Then you're going to make some assumptions about the implementation of the company's strategies. All of this in the broad economic environment. Now, when we take a look at what we have because of COVID, we're looking at two things. We're looking at a rebound, and then we're looking at a recovery. The best way to think of a rebound is this is all the pent-up spending that people have. They've increased their sales, and when this is over, you're going to see this boom, this rebound, if you will. And if we look at the graph, that is where we started here, dropped way down here. We're starting to come back, so this is really the rebound, just getting us to where we were. Recovery is going beyond where we were. So when we got to make our assumptions, we're going to make assumptions about the rebound. Then we're going to make a separate series of assumptions about recovery. Okay, so we're going to have to say we're going to rebound in 21, 22, and we think in maybe 23 we'll get up to that. Each one is going to be different. We see these changing every day. So I want you to distinguish between rebound and recovery. Now, this is just a couple weeks ago. What it does is it's from Bloomberg and Goldman Sachs together. And what we see here is the percent change forecast by quarter, blue being Goldman Sachs, red being the consensus. That's everybody else. So if we're looking, this here, what we're seeing, this expected spending in the second and the third quarter is the rebound. Okay? And we see it for the full year. And then we drop down into 22. And then as we drop down into the fourth quarter, we're down to that 2 to 3% growth. So these are broad ranges. If we take a look at the Fed's understanding, where they are, we see a couple of things here. Where they talk about the growth. Again, we see high growth, almost as high as Goldman Sachs, but then it's coming back down. So this is really the rebound. So we need to put that into our forecast, and then we're going to back down. So essentially, where we might have had a normal linear growth, we're going to have to make some adjustments. We're going to have to make it a little more specific. We're also going to have to deal with inflation. Now, right now, it looks like everything the Fed is saying and that we keep hearing is inflation is not a threat. Now, one of the things that is there's a lot of discussion on. This is not clear, okay? And the reason it's not clear is we have historically been taught that when the GDP grows, okay, that the GDP grows, that we will have inflation. Well, that's not necessarily true. Let's look at the next slide and we can talk about it. The broad assumption is that the faster that GDP grows, that the faster inflation will grow, that there's a level of correlation. That's true. And as I've said, some people think inflation is a real risk. We're seeing that right now in the equity markets. A lot of people believe that. And on the other hand, a lot of people think, no, it's not a risk. We saw this at the Global Asset Management Education Forum last week, where it was a very strong divide between inflation and no inflation. But I think something that hit me is when they broke it down. And you say, why do prices increase? Well, you have a labor force. You have not enough workers to do the job. That is then going to cause wages to go up if you have to pay more to get the qualified worker. Now, between the unemployed, underemployed, and those that left the workforce, there's still a 20 million available workers. So it's going to take some time for them to actually get back into the workforce while we've got efficiencies coming in at the same time. So I think that makes sense to me. I don't know. I mean, you're going to have to make your own decision on this. Then you're going to have commodity inflation. Demand exceeds supply is the general rule here. Yeah, the price of oil has been going up because of the supply side. They pulled oil off the market. So where it's around 70 now, the demand is not there. It's been reduced. The pandemic, but also as we've become more efficient, planes have become more efficient, cars have, we have the movement towards EV, but we're traveling less. So they're forecasted the demand to go even lower. So remember that inflation happens when the demand outstrips the supply. In this case, and in a lot of others around commodities, we have a bigger supply than we have demand. So we're not going to see it come from there. The other thing, the last one to think about is the ability of a firm to increase prices. Well, with the advent of the internet, online shopping, and more of us of shopping is done that way, there's transparency. We know what prices are. We have Amazon. At the same time, so we have a lot of opportunities, so it's much harder for companies to put a price increase through because they'll be the other. And then we have imports. That is still, we have the labor difference in different countries, which will enable that if prices get too hot, if they try to pass something through here in the U.S. at a higher price, imports might be available at a lower cost and thus keep the pressure to keep prices on. That's just something to think about. I think it would be a really good question for a quiz. So if you're keeping track of stuff like this, mark this one down. So we really have two things that happens with our sales forecast. One is our existing base business. This is sort of what's happening today, what we've done historically. The second one is strategies implementation. So we need to start with the rate and volume drivers. You figured them all out. Apply these broad economic assumptions that we're going to talk about and company or specific assumptions that will affect them. So when we look at the broad economic factors over a 5-year time horizon, we're going to have to look at each year simply because of COVID. We're going to look at GDP, inflation, unemployment, growth in consumer spending, price of oil. Now, remember, each one of these macro factors impacts companies slightly differently. So you have to take what we're going to talk about in the next lecture, the application, and apply it to your company. Okay? Then there is industry factors. Are there any specific factors that will impact your firm? And this can be many of them. How long will it take air travel to return to pre-COVID-19 levels? Then what growth happens from there? What's happening with home builders, restaurants, retailers? So we're going to have to look at those factors. So if we're and some of them, remember, for example, if you're doing advanced auto parts, electric vehicles are coming into play. And over the next 5 years, we're going to see a lot more. What does that mean for the company as sales, inventory levels, skills of workers, etc.? How are they going to be that? So we're going to apply the broad and industry assumptions. You have to translate them into your company. You're going to look at the drivers. Again, back to volume, back to rate. Everything is going to be about this rate volume. So you got to make an assumption for how you think each driver will respond in each case. Now, we'll go through this in more depth in the next video when we actually go through the sample for steel dynamics. So for each case in each year, you build your model, rate times volume equals sales per year. So that'll be the base, and we'll go from there. So that's the base. Now, what about impact to strategies? Well, you identified strategies. And I asked you, if you didn't specifically identify revenue in Project 1, that you need to identify which one of your strategies are going to impact costs and which ones are going to impact revenue. Select the two that you believe are probable. Okay, now go back to IFRS here. More likely than not to occur. And break them down. Only two. There could be 10, 15, but take the top two that you think are probable and are going to have a material effect. You break them down into rate and volume, and then the three cases. And these are additive to the base revenue. Then that'll enable you to see what capital expenditures and make assumptions around depreciation. So that's, just to summarize that again, you're going to have, for your forecast, you're going to have these set of assumptions. You're going to apply it to the base revenue that exists today under different scenarios, keeping in mind rebounding and recovering, depending on your company. Then you're going to layer in on top of that the two strategies that you think are really going to drive revenue for the company. Okay, so what we're going to do is now we're going to switch to the next video, and in the next video we're going to walk through once we've completed the sales forecast, we move on to expenses, then we're able to compute the profit, and then we can compute the cash flow. So let's talk about expense assumptions. Since you've gotten a good number for the sales that you can feel confident with because you've done it on a volume and a rate basis, you can then evaluate cost of goods sold. That's going to be a function of volume and rate. So if they're going to sell more, additional volume of product, then that means that you're going to have additional increases in costs. So when we're looking at cost of goods sold, we can make various assumptions about that ratio, what it's done historically, and what it may be able to do in the future. So this is where you got to take a look at some fixed and variable costs. But this is, once you get the volume down, this is a pretty easy assumption. So you either can assume that in a BAU case, the margin stays the same. In a worst case, it deteriorates. And in a better case, it goes down as they might pick up scale. Or they may need to add more expenses. You can also then make fairly easy assumptions about expenses, R&D, other. And some of this you can look at some of the strategies you identified around expenses, what they will do. Okay, so you might want to take a look at what fixed costs are and then variable costs. But the key driver is going to be that gross margin, which is a function of your volumes, your sales. Next thing that is important that wasn't there the last time we did this course was tax assumptions. In the notes to financial statement, there's a discussion of tax expense, and it reconciles the statutory rate to the effective tax rate. So the reconciled items include state tax, foreign taxes, deferred taxes, etc. Now, the current statutory federal rate is 21%, but there are some proposals out there as part of the infrastructure bill. One is to raise the tax to 28%. I honestly think it'll be closer to 24%, or what they'll do is raise it to 24, 28, and give people credit for creating jobs or buying equipment. Because the actual tax relief that brought it from 35 to 21, the money, one of the things was a policy perspective, was to increase jobs and capital spending. And companies just bought stock back, paid dividend, reduced debt. So it didn't have the impact that was anticipated. So I think we're going to see an increase, but I don't think it's going to be 28. I think it'll be closer to 24. So you got to make assumptions of what that statutory federal rate is. Okay, you can leave the others the same and then just modify that. Worst cases, it goes to 28%. BAU, I think 24. Best case, it stays the same, 21%. So that takes care of this general piece here. The next piece that's out there for you to work on is a LinkedIn course on financial modeling and assumptions. I want you to take a look at that. Then I have another video out there that I walk through how I've applied this on a quantitative and qualitative basis for steel dynamics. So what you're going to see in the steel dynamics is just my discussion around my assumptions. Okay? So if you got any questions, please let me know.